You have a very unique story because usually people start from smaller residential, right? 1 to 4 units, buying their own house. But you had eyes on the prize. You heard about real estate, about apartments, about multifamily. You just jumped right into it.
Here we see that's our differentiator, our unique value proposition that's not that many people can get in. It was everything we've done. Our entire portfolio is Class C, and it took us a year and a half. COVID happened, but we were still able to do business as normal there, so which was the great thing.
Hello everyone, welcome to Path of Progress. I'm your host Alex Kon, and today's guest is someone who's built an incredible career by exploring different opportunities and making them work together. Julian Sanchez is an entrepreneur who's taken on real estate and e-commerce and in a big way. He started with multifamily properties, expanded into assisted living facilities, and built a thriving e-commerce business. Julian, welcome to the show, man.
Morning, Alex. Thank you for having me.
Of course, it's a pleasure. Let's get started with your background, right? Story. Tell us how your journey began and what led you to real estate in the first place.
The short and sweet is I'm a Hispanic immigrant and lived in Orlando many years. I'm a UCF graduate, University of Central Florida, mechanical engineering. Did my career for about a decade. Somewhere in between there, after paying off all the student loans, there was some extra money left. And I'm like, let's do something smart with this money. Research, blogs, internet, books. And then I decided real estate. Okay, it's going to be real estate. And then, so I looked into Bigger Pockets, found Bigger Pockets. And then I used to travel a lot for my career. So anytime on the road, going to a job site, I would just be consuming all the podcasts. Just any second I was behind the wheel on a car, I just listen and learning. And then one in particular talked about apartment buildings, multifamily, how they are valued, how it works differently than residential. And I'm like, okay, this is it. This is what I'm going to focus on. Because at first, real estate is so broad, right? There's so many ways to make money or to invest into real estate. So like pick one. And that was the one. So
you have a very unique story because usually people start from smaller residential, right? 1 to 4 units, buying their own house. But you had eyes on the prize. You heard about real estate, about apartments, about multifamily. You just jumped right into it, huh?
And it made more sense because I knew more, or in my mind, it's like I know more apartments because from living there as a tenant for so many years. And again, I liked the model more. It made more sense, seemed more scalable. And then once I decided that, same thing, I found podcasts just
specifically multifamily.
Specifically multifamily. And then I'm like, okay, we're just watching these from now on. And then same thing. Time on the road, I would just be listening to multifamily podcasts.
Laser focus.
Laser focus on that. I meet my business partners, local meetup here in South Florida, in Delray Beach. And we just start. We bought the first one in Illinois after a year and a half of a lot of work, blood, sweat, and tears. It was a success. And then it snowballs. The hardest one is the first one.
Okay, let's reverse a little bit. So Bigger Pockets. I love it because everyone who is coming on this episode, everyone on this podcast is talking about Bigger Pockets and how they change their life. Everyone. Me myself, right? It took me a year of, sucking all the information from Bigger Pockets podcast and buying my first residential, small multifamily, like 2-unit, and then going to 7-unit seller financing. And I learned all this new tricks from the podcast. And that's how we need to learn somewhere, right? We don't come from real estate. We don't have any immediate exposure to this. So we need to learn it one way or another. And Bigger Pockets open this door for us. You told me it took you 1.5 years, right? From start when you started learning about it and to buying your first multifamily. So tell us a little more about your first deal.
First one is building we still own to this day. A 16-unit in Illinois, in central Illinois. It was everything we've done. Our entire portfolio is Class C. And then also heavy rehab, most of them, heavy value add. And so, this building was pretty much vacant. So we got it at an incredible price. The few handful of tenants, we gave them some money to just leave, and then we just boom went to work on the whole building. Made many mistakes. We had a lot of difficult times. That's why I was saying it took us a year and a half, the full remodel. And there were, we could talk about this deal for hours.
I'm curious more. You live in a landlord-friendly state, right? In Florida at that time, but you decided to invest in Illinois, which is opposite, right? Which is tenant-friendly. So tell me what made you to do this change, and were you scared of it, or did you have already enough knowledge and partnership on that side to jump out of state right away?
No, we had nothing other than I wasn't scared of the risk in my mind. So this was my thought process. And to parenthesize, when we bought this deal, I used like all my money, like every penny I had ever saved my entire life. Kind of like when people playing poker go all in like that with all the chips.
Yep.
So
been there.
Same way. But in my mind, it's like, I'm 30 years old. If this goes worst case scenario, I lose everything. Well, I'm still 30 years old. I have my career. I can make the money back. But instead, will I regret not doing this years ahead, not having taken the chance, not having taken the risk? And well, that was the answer. Oh, and the deal came by to your question. Why? Because we were looking in the Midwest. My partner Andres, he already had some properties in the Cleveland area, smaller multifamily. And then, well, that was a conversation when we met. He wanted to get into commercial, bigger units. So we had already looked in Cincinnati. We almost had a deal there that just didn't occur. And then we came across this one, and we're like, let's do it. And we got it at an incredible price. Again, it needed a lot of work. It was a small town. So let's do it. Now it was just up to us to execute the business plan. Okay, we got to rehab all these units. We got to put it to market. We got to fill it up with tenants. And it's like, okay, worst case scenario, these are Section 8 rates. And okay, we have the building, this occupancy. Hey, we still make money.
You went on a classic value add model, right? You chose a Class C building, come and renovate in every single unit, changing the tenant base, improving your rental rates, improving your NOI. For all listeners, NOI, net operating income, is your gross income minus your expenses. You get in your NOI, and then you get valuation higher, right?
And to my previous point is like, that's why I chose multifamily, because I like that model. Because I can control, to an extent, my expenses. I can try to push rents higher by giving, certain amenities or making things better for the tenants.
It was more or less predictable outcome, right? So you have calculated risks there. That's why you were easier to go all in, because you already had those numbers in your head, and you think, okay, this is the end game. This is what we're looking forward, and that's probably going to happen. And that's what happened, right? So what year did you get this building? Let's talk about it. Numbers.
That was 2018 when I started.
2018. Okay. And how long did it take you to stabilize the building? Considering it's a first building, right? You did everything wrong.
Year and a half was full cycle till we refinanced. So we were done with everything in 1 year. Yeah, 12 months.
Okay, in terms of value creation, right? You bought the building for X. How many multiples you got? Did you increase double your value of your building, or what was the exit strategy?
This deal has been, in terms of numbers, value, return, it's been the best deal we've ever done till this day. So, and it's kind of unicorn. We don't expect to ever do that again. Just given various factors and the price we got it for, etc. But it was a many multiple of value from what we purchased it for, what it was valued. So we bought it for $150,000. Yeah, exactly. We put in about $250,000 in rehab, and then valuation was 1.1.
Love it. And more than that, you have infinite return, right? You did a refinancing of the property, you still keep it, so you got all your money back and all your partners back, and you just keep cash flowing.
When we received, I still have the check here somewhere. The cash out proceeds were astronomical. So even after paying everything off, so we paid ourselves back, received proceeds, and still own the building to this day that cash flows.
Love it. No, this is a great way to get introduced to multifamily, right? You get your success story, proof of concept, and working with your partners together. So now you got more hungry. Now you got excited about the space. So what was your next step? How did you scale it?
Just keep buying more. It's like, okay, let's just repeat what we just did. There's no, it's not rocket science what we do, So it's just, let's repeat the same process. Like, okay, what other market? Because yes, Illinois, unfortunately, it's not somewhere to continue to invest. So we looked at, my partner Andres did some research, and it's like Arkansas. It's like, okay, it's the most landlord-friendly state in the country. So we bought a portfolio of, multifamily there. That was the next deal the following year, 2020. Right, COVID happened, but we were still able to do business as normal there. So, which was the great thing for us. And then we did full cycle on that one, purchased another, and it just snowballs. You just keep, now you have a track record. Now you've shown proof of concept. Now you can bring in investors. Now, you've shown that you know what you're doing and that you can execute. And so now it's just rinse and repeat, finding those opportunities, finding those properties with the value add, and just doing it over and over again.
So Arkansas was easier during the COVID, right? They didn't have all those crazy restrictions.
No restrictions.
Nice. Well, at that time, I closed in January on 7-unit seller financing.
Okay.
And we had a high taxes, and I had to pay all this and I couldn't find any labor. So I had to drive every day from 1.5 hours from Fort Lee, New Jersey to Trenton, and doing rehab and getting a few people just to help me. But, I muscled through it. The same story in a year and a half. We were done full cycle and we tripled the value. Hard work and dedication is all you need in this business. You just keep going, keep pushing. Okay, so let's talk fast forward in multifamily. Let's keep focusing on multifamily for now. What does your portfolio look like today? Can you share with us?
300 some units about in various states. Most of the concentration is in the Cleveland market. But yeah, Ohio, Illinois, Arkansas, South Florida. And yeah, all Class C. That's all we've done so far.
Yeah, I love it. And how did you buy all of those? I mean, you just started not a long time ago. You didn't have always this much cash to put in those buildings. How did you close on those properties?
So as we grew, people we knew saw what we were doing. They wanted to invest with us. So we started doing syndications, as you may know how those work. And as the deals would come, we just raise money from investors and take them down. And because they're all typically, again, we buy heavy value add. So we put bridge debt, fixed, now floating rates. So that's how we were fine during this crazy rate increases the last couple of years. They were 3-year terms typically, but fixed rate through the 3-year term. So right now, as we're coming up, we got a few to refinance first, second quarter next year.
But you executed your business plan, right? You executed your business plan, so you're not worried about refinancing. You have some predictable outcome. You know where it should be in terms of appraisals, so you guys will be okay on the refinancing.
Exactly, and because we've created the value and increased the value of the property, I mean, we can refinance, pull our money out, our investors' money out, do a cash out, and continue to hold the asset indefinitely. Or the property is now valued more, or we sell if the rates continue to be crazy high.
Do you consider selling those, or do you, as you mentioned, you just your original plan is to keep as much as you can? And
original plan is always to keep. We're still talking about multifamily, but we fell into the asset class of assisted living facilities 3 years ago, and we've liked that one. We've liked that asset class. So we see higher returns, higher use of our capital and our investors' capital into that asset class. So we may put some of the properties on the market to sell.
Okay, well, you mentioned that. Do you syndicate as well assisted living facilities, or you do JV deals?
Yeah,
the same kind of structure. So on a residential multifamily space, we usually have 5-year underwriting, right? For those, what is your model looks like? Do you underwrite on 5-year cycle or on a run through?
We'll underwrite it so our investors can compare apples to apples. This is what it would be on a 5-7 year hold, which is the typical what syndicators do out there. But again, because our model is to create value and increase valuation of the property, we do typically a 3-year hold. So in 2 to 3 years, we're returning investors' capital, their investment, and then either continue to hold the asset or if and when we sell.
Right. So you're trying to underpromise and overdeliver. So you're trying to give a target of 5 years, but if you can do it in 3 years and give them money back and give them returns, solid returns, and just go for another deal, you would rather do that, right?
Correct. It's just velocity of money.
Absolutely. And on assisted living facilities, it's another very interesting topic, and I would like to hear more about it. Before we dive into details, on syndication side, is it also a 5-year projection, or do you have a higher, faster return on those deals?
We projected similar, but again, even the ALF space, we look for the value add. So it's like the one we own here in Pompano Beach in South Florida was distressed, had a lot of vacancies, census was low. So we've since increased the amount of residents in the place. I think we're almost not at 95%, we're at 100% right now. And done a lot of work at the facility. So now, again, we've increased the value from a $5.7 million when we purchased it. Right now, we could probably sell it for $9 million. So
okay,
that's the same concept.
Yeah, you increase the valuation, you create equity in those buildings, and you're going through the cycle. So for you personally and for your company, would you still buy multifamily properties, or you want to completely focus on assisted living facilities?
The idea is it would have to be a crazy good deal, a crazy good multifamily deal, kind of like our very first little building in Illinois.
So what is your buy box for multifamily? If we have any listeners who has any deals.
It's been C-class, again, at a low cost basis, needs work, is distressed. It's ugly. There's problems. That's our buy box.
Any unit size that you're looking for?
We've done medium-sized multifamily, 40, 50, 60 units. So you can be, and that's a sweet spot of ours, being between 20 and 100. We haven't gone 100 and up community yet. That's where we've played.
So basically landlord friendly, US states and, around 50 units. Distressed, yep. That's value add classic. Okay, perfect. So let's move on to assisted living facility. How did you found this asset class? What did push you to start looking at this direction?
Long story short was COVID was raging, hotels going out of business. I had the idea, hey, find hotels, convert into multifamily. That could be, an idea. I meet a broker. He sells, hotels to convert into ALFs. Like, we don't know ALFs. He's like, hey, there's one for sale in Pompano. We're like, let's look at it. We looked at it. Numbers look great. And we bought it. And that's also why we like it, because it's a lot higher barriers to entry. Multifamily became like a craze in, I think, 2021, and everybody and their grandma wanted to buy multifamily. So here we see that's our differentiator, our unique value proposition. That's not that many people can get into buying an assisted living facility space, because they also vet you, because it's heavily regulated, right? Here in Florida, every state has their own, state entity regulating assisted living facility, hospitals, nursing homes, etc. So for you to be licensed to own and operate an assisted living facility, there's a lot of things that you personally have to go through. They check your background, criminal, financial, etc., etc. And then, when it comes to buying one and owning one, the typical real estate investor is not gonna. It's a lot of people. We have 20-something employees at the facility. one facility. So now you're dealing with people, salaried employees, full-time employees, and everything that comes in between running a facility. That's also, you're running a hotel, a restaurant, laundry. All these services are provided for the residents. So it's not something that the average investor going out the gate is going to get into.
Yeah, more risk element. And when you started with this first property, did you have a partner who knows about it already, or did you have to learn about it yourself?
No, it happened, and we probably wouldn't have done it otherwise. We partnered with these two ladies local that they know assisted living their entire lives. And so one of them basically keeps the place full, knows everybody in South Florida to get us residents consistently going into the facility. And the other one knows ACA, the state regulatory agency. She used to work there. So she keeps us in line, out of trouble with them. So that it all happened almost by fortune that they were there as well, because otherwise, yeah, we probably wouldn't have done it either.
So basically you plugged in yourself into successful operation and you just improved it, right?
That's a very good way of putting it, yes.
Okay, so one of the main important things for our listeners, if you want to start a new business and a new venture, have an operator who already knows about this business and who already done it before and who can explain to you the ropes of this business, right?
Yeah, that's what's worked for me, or it's been my leverage. Like I leverage other people, leverage everything is leverage. The bank's money, credit, etc. It's all that's what I've done.
Okay, and this is your first facility. Do you have any other facilities, or are you just looking in this direction?
Buying another one first quarter next year.
Love it. So you're on track. And how big is the first facility? How many beds do you have there? 71 beds. Okay. And this and what are you looking in future to buy new facilities? Do you have a minimum bed count on those?
60. We've been advised to do, at least 60 and up, just from because
operational
again per regulation. Yeah, and per regulation, you got to have a certain minimum employee count per resident. So after 60, it's, the same employees that I have for that kind of size facility can serve the same if it's more and more, let's say 70 or 80. So you get more bang for your buck, per se.
Okay. Again, assisted living facility. And in this space, what is your average? In multifamily, we know 1 bedroom has a specific rental rates, 2 bedroom. In assisted living facility, when you underwrite those facilities, do you have some platforms that you can run where what as the numbers should be? How do you underwrite those?
More than what the numbers should be, we look at a ratio. And so when I'm underwriting multifamily, and this is what I've done, like my back of the napkin, is we have so much in rent, so much in revenue. Operating expenses are typically 40%,
right?
Even though we typically run, but that's my quick, 40% operating expenses, even though we typically we're at 33.5% in our operations. But it's like, if I'm underwriting a deal, 40% is the expenses to run the building, right? With assisted living, it's 65 to 70. It's a lot, you're running much heavier a business with a lot of overhead.
Right.
But that's my ratio that I look for, and that's where I calculate. And so if I see, let's say I'm underwriting an ALF, and I see they're spending a lot more than that, or as I was recently underwriting one, as a matter of fact, in Central Florida, their operating expenses are about 80% of total revenue.
Oh.
I'm like, well, they're doing something wrong, or there's something there we can go in and reduce costs. Either they have too much staff, or who knows what they're paying for their food, etc. That's my benchmark. And then when it comes to actual cost per resident, it varies a lot, because if you have high-end luxury assisted living facility, those can be anywhere from $7,000 to $10,000 per month in the right markets. But whereas the ones we are government subsidized, so Social Security, Medicaid, pays for our residents. And so it's on the lower end of about $3,000 per month per resident.
But you have predictable income because it's coming from the government. It's like
Exactly.
Section 8 in multifamily.
It's the Section 8 equivalent of assisted living.
Okay. And I know there's a few levels of assisted living facilities, right? There are some residents that live there. There's nursing facilities, like yours is specifically people live there and you have staff just taking care of them, right? They long-term tenants. So they live there until the end, right? Basically.
Yep, they live there.
Okay. What unique challenges you had or managing assisted living compared to multifamily properties?
There's been a lot less. That's why the irony is it's higher revenue generating, higher return, and yet for us it is less bandwidth, it is less headache, less trouble, because again, we have 20-something full-time employees, a salaried administrator running the place.
So just have an operator inside and just that helps to run. You have just
that you're paying. It's a full-time salaried employee versus, and even though, so with the multifamily, we also self-manage. We have our own property management company, Easy Living Property Management. And we have a full-time team of 8 right now that manages our properties. But still, it's like right now, we had a boiler go out last week at one of our properties in Ohio. Boilers are shut. Okay. So this is a big ticket item. It's about $50,000 if we were to replace them. And it's like, okay, let's find alternatives. And I'm looking. And so big tickets like that, I typically, in the technical side of things, I get involved. I guess just from my engineering background, etc. So like that's something I was dealing with just this weekend that I found a solution, cheaper solution.
But this is extra like bonuses, right? When people invest with you in multifamily, they also get a experienced property manager on board in-house. And it helps them to remedy all this risk that potentially new state, there is no property manager. You guys you plug it in there comfortably and you can know all ins and outs. Okay, but again, you chose this model, right? A lot of operators, they don't do this work. They just do asset management, overseeing, like you do with assisted living facility. And I know it can be a headache, but for you, you're saving money and you're also making more money because you're saving on property management, and now you have more control of this. And control sometimes comes with a headache like this, right?
Yeah, but it's done. So it came out of necessity because, like in Ohio, in Cleveland, the property management companies that are there are just terrible. There's no good ones. So we're like, we just got to do this ourselves. And so we started hiring people internally that have been great. And thanks to our amazing team. So, and they've run the business, day to day, almost 90-some%. It's when big ticket items like this pop up, it's like, okay, that I get involved or one of my partners get involved.
Basically, by running this particular model, it enabled you to invest in the areas where other investors wouldn't probably touch because they don't have a reliable property manager. And now you have, advantage because you have everything in-house, the knowledge and people, and your experience of doing this already in different areas. It enables you to invest smarter in this way and to get more opportunities that other people will shy away from.
Correct. I would say so.
Love it. Okay, so you got multifamily, you got assisted living facilities that you grown, you keep buying, you keep looking at this asset. What is the next thing for you, the big thing? I know you're also an entrepreneur in your soul and you try in different directions, and you, as we know, we all real estate rich, net worth rich, but we also cash poor. How did you fix that for yourself?
E-commerce this is my e-commerce brand. It is not Amazon. It is other and less saturated, less competitive marketplaces in which we sell our products in. So it is something I've been doing now for 4 years. Started with Walmart it was kind of an experiment. And then from there, it grew into what we have creative today and that I have access. And so it's like I signed an NDA a couple of weeks back with Target to sell on their platform. So you don't hear nobody doing that. Michael's, Wayfair, Kroger. So on these marketplaces is where we're doing business. So, and it's been something fun. And I'm just, again, leveraging, I don't have all my credit card stack here, but leveraging the bank, leveraging credit, that we just find something, we buy for $1, sell for $2, and make $1, and just buy it using the credit cards and still get the points, miles, rewards that come from it. So it's been fun. And then again, it's weekly money coming into bank.
You diversifying your energy into different class assets, and you trying to understand what else out there. So what kind of products are you focusing on when you selling on those platforms? Is there any specific ones, or you just researching what's cheaper?
Exactly. And that's what the team does, just research all day, every day, what we will sell now. So like my Michaels store, for example, exploded during the holidays because it's Michaels. It's like ornaments and crafts, and it's things people bought for Halloween,
seasonal,
Thanksgiving, Christmas.
Right.
So seasonal. That's that specific store. And then each one will have its own particular products and items that sell consistently or peak during the holidays or not. That's those stores. And if one is to sell on other marketplaces, then there is creating your own brand or creating your own product, which is something I might get into as in the next year. But for now, that's been our model. Two-step drop shipping in these platforms.
You have to have the supply, right, of this product in-house in your warehouse, or do you ship it to them, to their warehouse?
No, exactly. So that's the beauty. With this business model, there's no upfront inventory costs. There's no overhead from holding it. There's no risk either of it not selling. So when the order comes in, supplier sends it. He takes their cut. Marketplace takes theirs. I take mine. Everybody makes $1, and customer gets packaged.
Now I understand. So you basically looking for supplier. You're just a middleman, right? You get in agreements with marketplaces, and you get in agreements with suppliers, and you are, when the order comes in, you just middleman. You just processing this order basically through your platform. Okay, and talk about numbers. Can you share some numbers of it? How large of a volume we're talking about?
So I'll use my Michael store again, for example. Over the holidays, year to date, we're close to doing the million this year, but it was about 800,000 in sales we've done year to date. So we probably won't cross the 7-figure mark with that store in particular. But for anyone listening, or what is most relevant to potential partner, potential client, because I offer this as a done for you service as well, is 5 to 8% is the net return of total sales. So for every 100,000 we sell, let's say in a month, 5 to 8,000 would be the profit.
Okay, that's your margins. I understand. And are you talking about margins when someone working with you specifically, or your own margin?
Both, because the way I have structured the model is we just split everything 50-50. So out of those margins, we just split profits.
Let's talk about this model. So for our listeners, let's dive deeper into it. So if someone want to try this model, of course, learn it by themselves will be time consuming and risky per se. But if you have such a proven model, first of all, why do you want to teach someone else to do? Are they going to undercut your product, or are you going to have new product for them?
I'm not teaching. That's what's different. It is a partnership. It is the person, their LLC, their company, their bank account, W-9, EIN, everything. And then it's just me and my team manage and operate everything in the back.
Okay. How much is to start something like this? Is there any upfront costs?
So there's an upfront buy-in that just goes into, there's about 128 man hours I have calculated that goes into preparing, because let's say you come in as a client, as a partner. And then, so we got to create a website with great product images, Alex Kon e-commerce LLC has to look like it's a legitimate existing e-commerce business. So when I go apply to sell in these marketplaces that I just mentioned, you get approved. And so it's all that work that goes in the background, a lot of administrative tasks, just back and forth communication with the marketplaces, and to get somebody's LLC approved to sell in their platforms.
Okay, and how long does the process take? You calculate 128 man hours, but it takes time to get approved to those stores, right? It takes time to research on this product.
Yeah, over a period of about 6 to 8 weeks is from start to beginning that will get approved on a store.
Okay, and if someone wants to start this business, when is the best time to start it with you? Is it for holidays? Is it a good time to start on Christmas? Or
You would want to start it and be up and running. I guess for e-commerce, I mean, any retail in general, yes, the holidays are the Super Bowl of where people spend the most money, right? I had a number, and I want to know what it was this year because holiday sales in the U.S. last year were $964 billion, just holiday sales in the U.S. So this year it's probably going to be 1 trillion.
we like to spend.
So yes, the best time is now, because that way, whatever time you're in, the store has time to mature and start getting sales and growing. We don't, and to be totally transparent, a store, I don't open it, get approved, and then that same week we're just selling hundreds of thousands of dollars. No, it takes time to build up.
Okay, so that was my question, right? To open a store, you said it's 6 to 8 weeks, but to warm it up and to have some sales from it, when we can have predictable income, from your experience, how long does it take? And if it's not per se holiday seasons at this particular time of the year, what is your advice? How long will it take to in a normal time without holidays?
I would say 4 to 6 months to get the store established, make sure there's not too many refunds. There will always be returns because people are just people. But have no bad reviews, those kind of things. And then sales just start increasing naturally.
Okay. And let's touch again the topic of how much it will to start, right? To start the process. So what is initial cost?
What I have right now is an upfront. I have a discount for anybody paying upfront. It's $20K, or that's a 20% discount. It's $20,000 if they pay all upfront, or different tiers of payments for those that can't pay. And it can also be a credit card. And so for people out there, they're starting out, have an LLC. If you don't have let's say the business credit yet, we can help you get that too. As long as your personal credit is as well, that's part of the offer as well.
And what kind of agreement do they sign with you as an operator? So you're basically going to be the operator, like you have an assisted living facility, but this is for this e-commerce business. So Julian is operator for you guys. Everyone who listens, he's a professional. He does it successfully, and now he can do this for you. So what kind of agreements and what kind of security people have when they pay upfront this money, and what can happen? As any investment, it's a risky business. Anything can happen, but what kind of safety net you can give them?
I have it's a 12-page contract. I forget how many pages, but that goes over what's required from both parties. And then I have an 18-month guarantee. If you haven't made the buy-in in 18 months, 100% of profit are yours until you've been made whole.
Okay, so it's a no-brainer deal, right? We have something that we can control, and we can return our funds potentially within 18 months lifespan. And you already 18 months, this is from start to finish. You have warm-up account 6 months, and you already touching this holiday season. So if you want to start now in 6 months, by summer, Memorial Day, some other big holidays, you already have some idea. July 4th probably is going to be a big one too for seasonal stuff. We already can have our proof of concept. By holiday season, we already can make a bank. And just from my understanding, in this process, we already set it up. Will there be a requirement for additional funds from out of pocket, for example, to process those orders? Or the people pay those orders and right away you just transfer the payment to the supplier? Or how does it work?
Correct. We buy directly from the supplier, and they fulfill the order when it comes in. And then the marketplaces pay out the partner directly to their bank account. So it's your money, you receive it, and then you send us the profits. So the partners control the money coming in. And also, the purchasing power. because it's theirs. And that's why I did this model, because, well, not only it would also benefit me to have more volume with my suppliers because they would give me better rates and lower shipping costs. But again, having the purchasing power of other partners, that way we can just keep growing. So that's a requirement. You got to have at least 40K, ideally more. I mean, my Michael store is about 180K so far this month. We'll probably do 200K this month. So ideally, you want to have more.
And to play devil's advocate, right? Why don't want you grow additional stores yourself? Why do you want to share with someone else? I mean, if you're successful and it works as great,
Possible for me, my parents, my wife, as well.
Is there a limit how many stores you can have for yourself?
There's a limit. I mean, per marketplace, per LLC, yes. I'm applying, and that's what's also unique, because I have access to different marketplaces. So we're applying that. I'm applying to Target right now to get a store with them. The biggest limiter is, again, credit. I'm working on getting a few unlimited credit cards. So that's the growth, right? That's what inhibits.
You can only move as quickly, right? So for you, it's going to be quicker if you supply extra stores for other people and open every time LLC, warming up LLC and doing everything for yourself. So instead, you just multiply and you create multiple stores for other people, and you have this model of scaling, and you're just doing operational part of it.
And since I already have the back, I have the team anyways, I have the operations. So it's like, yeah, why not offer it as a done for you service?
No, yeah, it's at the end of the day, everyone has to eat, right? And it needs to make sense for all the parties. Love it. I think it's a great concept you got there, and we'll talk separately on this topic more. I'm very interested to learn more about it, and I'm sure we're gonna come back to this conversation. Okay, so one last question. If someone wants to connect with you about assisted living facility or multifamily properties or your e-commerce projects, where can they find you? Do you have some aggregate websites that you have different projects that you carry?
Yeah, our website, our real estate investment firm is Elan Capital, ELAN capital.us. My the e-commerce business is prosperapartners.co, and you can find me on social media as Julian Sanchez.biz on all social media platforms.
I love it. Awesome. Julian, thank you so much. I think that's a wrap. Thank you so much for sharing your journey and insight. It's been great having you on the show.
Thank you, Alex.
Of course. Pleasure having you, man. To everyone listening, thank you for tuning in to Paths of Progress. Don't forget to subscribe, leave a review, and share this episode with anyone who is on their path of progress. Stay tuned for more interesting, inspiring conversations. And as always, keep moving forward. See you next time.